Hello and welcome. This is Sid going to explain option trading basics. Many people think options are just for risky speculations, but that's not true. Options are simply contracts that give you right but not the obligations to buy or sell a stock at a specific price by a specific date. They're powerful tools that can transform how you manage your portfolio, offering solutions to three core problems every stock investor faces. Every successful stock investor faces three critical challenges that limit their success. First, you have unprotected risk. A sudden market crash can wipe out your gains because your portfolio has no insurance. Second, you face capital inefficiency. High quality stocks are expensive, tying up large amount of cash in one position and limiting your ability to diversify. And finally, you have idle assets. Your long-term stock holdings are just sitting there, not generating any cash flow. The question is, how do you solve these problems? The answer lies in the option toolkit, which provides the shield for risk, the lever for capital, and the engine for income. If you own stock, your total risk is the entire investment. That's where tool number one, the shield, comes in. It's how you protect your assets from the unexpected. The best way to think about it as an insurance for your stock. Imagine you buy a Ferrari. You pay a small fee called a premium to an insurance provider. By buying a put option, you are doing the same thing. You pay a small premium to create a defined floor for your investment. This contract gives you the right to sell your shares at an agreed upon price, called a strike price, no matter how far the market price drops. So you cap your downside, protecting your investment while you're still enjoying all the upside. Let's see how the shield work in these two scenarios. The setup is simple. You own 100 shares of XYZ at $125 and you pay a $500 premium for insurance. First scenario, the stock rises. If the stock rises to $132, your profit is $700. After paying the $500 insurance cost, your net profit is $200. Yes, you give up some upside for these protections. Second scenario, the stock falls. In this scenario, if the stock crashes to $113, for example, your potential loss would be $1,200. Because you had the put option, your maximum loss is now capped at $500 that you paid the premium. You saved yourself $1,200, and that is the benefit. The second challenge is the capital inefficiency. If you want to buy 100 shares of a $125 stock, you need to tie off $12,500. That is a huge commitment of capital. And this is where tool number two, the lever, comes in. What if you could pay a small fee to lock in the right to buy the stock later? The solution is call option. It gives you the right to buy share at an agreed upon price. The core benefit is clear. You can control 100 share of a stock for a small fraction of the cost, like paying only 500 instead of 12,500. And if the stock falls, your maximum loss is strictly defined to just the premium you paid. See the difference? Let's compare buying a stock versus buying a call option. We are bullish on XYZ stock currently at $125 and we buy one call option for a $500 premium. Scenario A, the stock rises. If the stock rises to $137, buying the stock gives you a 9.6% return. But with the call option, your investment is just $500 and your profit is $700. That's a massive 140% return on your capital. Now the scenario B, where the stock falls. If the stock crashes to $100, the stock owner has 2,500 unrealized loss. But with the option, your loss is strictly capped at $500 premium that you paid. This shows how a call option is a capital efficient way to speculate with a defined risk. The third problem is the idle assets. You may own a great stock like Intel for a long term, but it is not generating cash while you wait for it to appreciate. The solution is tool number three, the engine. You can turn your stock into an income generating machine. The concept is like to act like an insurance provider. You sell a covered call against the stock you already own. You collect guaranteed immediate cash, that is premium, in exchange for an obligations. The trade-off? The good is that you get paid weekly or monthly. The bad is that you limit your upside if the stocks skyrocket past your strike price. So basically, you trade a little potential growth for consistent income. Let's see how the income engine works with a covered call. We own 100 shares of Intel and immediately collects a $150 premium by selling a call option. Now the four outcomes. If the stock falls to $30, your premium cushions the loss, resulting in a minimal net loss of only $50. And if the stock stays flat at 32, You still make $150 of pure profit, generating a 28% annualized return on a flat stock. And if the stock shoots up to $40, you missed a gain above $34, but you still walk away with a fantastic 66% annualized return. So the covered call lets you generate consistent income regardless of whether the stock goes up, down, or stays flat. And that is the beauty. Before trading, you need to know the core component of an option contract. First, remember, the one option contract controls 100 shares of stock. Always multiply the quoted price by 100 to find the total cost. There are two types. A call options gives you the right to buy stock. A put options give you the right to sell stock. Finally, the three key terms. Premium is the price of the contract. The strike price is the agreed upon price where the transactions can occur. And the expiration date is when the contract becomes void. An option price or its premium is made up of two things, intrinsic value and extrinsic value. Intrinsic value is the real tangible value if you exercise the options right now. Extrinsic value is the potential value driven by two key factors. First, time until expirations. More time means more value because there is more chance for the stock to move. This value disappears as time passes, which is called time decay. Then implied volatility. This is market's expectation of how much the stock will move. Highly volatile stocks have much more expensive options. And finally, some key metrics to watch. The Greeks are simple metrics that measures an option's sensitivity to different factors. Think of them as an option dashboard. Delta is the speedometer. It measures how much price changes for every dollar movement. A delta of zero point 0.6 means your option goes up by 60 cents when the stock goes up by $1. Theta is your timer. This measures your daily price decay due to the time passing. A negative theta means your option loses value every single day. This is the option seller's best friend. Vega is the volatility meter. It measures how sensitive the option price is to the changes in the market expectation of movement. And gamma is the acceleration. This shows how quickly your delta will change as the stock moves. Remember, as a key takeaway, when buying option, you want high delta and low theta. High delta because you need the option price to move quickly and with the stock in your favor. Low delta, low theta because as an option buyer, time decay is working against you. You are paying the theta cost every day. When selling options, you want low delta and high theta. You want to start with low delta to minimize the chance of option expiring in the money. And you want high theta because an option seller, time decay is working for you, and you are the one collecting the daily decay value. I hope this explainer is helpful. I'll make deeper mathematical analysis. If you want to know more, just add a comment, and with 5 comments, I'll make the sequel. Thanks for watching, and this is Sid signing off.